The Indian rupee is under pressure, and this time global research firm BMI has sounded the alarm. The rupee could weaken further. The Indian rupee has fallen to around 95.75 to the dollar, its weakest level since late July, and BMI, a Fitch Solutions subsidiary, is warning that the slide may not be over. The research firm expects the rupee to weaken to 97 per dollar by March 2027 and 99 by March 2028. That is not a prediction of a currency collapse. It is a warning that rupee weakness could become a persistent trend. The currency has already weakened by roughly 5% since the Iran war began, as oil prices surged and investors moved into a broader risk-off mode. The immediate pressure is oil. Brent is nearly $92 a barrel, and with India importing around 90% of its crude, higher oil means a bigger import bill and stronger dollar demand. But oil is only the cyclical story. The rupee was already Asia's worst performing currency in 2025, and the weakness has continued into 2026. BMI says investor concerns are increasingly extending to India's longer-term growth prospects, particularly the impact of AI on its services export engine. Software engineering and call center operations are particularly exposed, and there are already early signs of pressure, including hiring freezes and fewer entry-level positions. And in medium to long term, the AI disruption could become a structural issue. If it weakens India's services export earnings, one of the country's important sources of foreign currency, then there's another major risk: US trade policy. India faces the possibility of higher US tariffs linked to its purchases of Russian crude. BMI has warned that threatened tariffs could reach as high as 100%, and that matters because the US is India's largest export market. A major escalation could hit Indian exports, investor confidence, and ultimately the rupee. But there's one institution standing between the rupee and a much sharper fall: the Reserve Bank of India. The RBI has been repeatedly intervening in the currency market for around 10 days, the state-run banks selling dollars on its behalf. So right now, the RBI is effectively slowing the rupee's descent, but it cannot permanently remove the underlying pressure. India does have important buffers: capital inflows, remittances, and a stronger services surplus can support the external balance and prevent a much more severe deterioration. But those buffers are being tested by higher energy costs, trade risk, and global uncertainty. And this is where the rupee story becomes bigger than the exchange rate. A weaker rupee means more expensive imported oil, which will feed into domestic inflation. Imported machinery, electronics, and other dollar-priced goods become more expensive. Indian companies with dollar liabilities face higher cost. Overseas education and travel become more expensive for Indian households. And if the rupee continues weakening, the pressure can eventually spread from the currency market into inflation, corporate costs, household purchasing power, and monetary policy. And the RBI is already watching that inflation channel closely. The real story, therefore, is not simply whether the rupee touches 96 against dollar. Underneath the immediate pressure is a more structural layer: energy dependence, trade vulnerability, a widening current account deficit, AI disruption to services, potential job losses, and a currency that has already been one of Asia's weakest performers. BMI's 99 forecast is therefore more than a number. It is a warning that the rupee's next phase could be about managing a prolonged decline, not simply stopping a temporary sell-off.